Hello everybody, let me welcome you to your own channel, The Secrets of Wealth once again. If you are an existing mutual fund investor or maybe going to start your first investment in mutual funds, then watch this video patiently, because in this video you will learn how you can choose the best mutual fund without the help of any industry expert. In this video, I'll be comparing 24 ELSS mutual fund scheme with the help of 11 indicators that will make you an expert in this field. What are those indicators? Let's find out in this video. But before that, let me give this disclaimer very clearly that this video and all other videos in this channel are only made for education and entertainment purposes, and it is not at all any kinds of investment advice. It is always advisable to contact your financial advisor before taking any of your financial decision. So without wasting your time and the time of mine, let's begin. First indicators to be followed is fund size. By the meaning of fund size, I mean to say AUM or asset under management. In case of debt funds, higher is the size or AUM, higher is the benefit. Higher AUM indicates that funds are flowing into these funds periodically and the reputation of the fund is very good. And more importantly, as the need of the portfolio churning is less, in case of debt funds, big size doesn't matter. And in case of periodic redemption pressure, fund managers doesn't face any issue. But in case of equity mutual funds, fund size impact adversely. With large fund size, fund managers finds difficulties to make stock entries and exits. Especially this thing impact more if the fund invests in mid and small cap stocks. On the other hand, in case of smaller size mutual funds, per unit operational cost increases with the portfolio switching. That increases the fund management charges and literally it takes out extra money from your pocket. The second indicator is historical returns. Always try to see the return of the fund for at least 5 years and compare it with the related benchmark indices based on Nifty or Sensex in case of equity mutual funds, and treasury bill or government bonds in case of debt mutual fund. Constantly higher return is always better. The third indicator is standard deviation. In simple term, it measures the volatility of the fund. Higher the number, more volatile is the fund. Always low standard deviation value is preferable. The fourth and fifth indicator is Sharpe ratio or Sortino ratio respectively. In simple word, Sharpe ratio and Sortino ratio compares the return of the investment with its risk. Sharpe ratio is the reward to risk ratio that focuses on the total risk, while the Sortino ratio measures the downside risk of an investment portfolio. Basically, both indicators calculate the risk adjusted return. Sharpe ratio evaluates low volatility investment and Sortino ratio evaluates high volatility portfolio. Generally, Sharpe ratio between 1 to 2 is considered good and Sortino ratio of 2 and above is considered good. The sixth indicator is beta. Through beta, the relative risk of mutual fund portfolio is measured. Through this ratio, it is measured that how much the fund is risky compared to its benchmark index. If the beta is 1, it means that the fund is carrying the similar amount of risk compared to the index and the volatility is same as the index. If the value is less than 1, then it is less riskier compared to the index, and if it is greater than 1, it suggests that the fund is more riskier than the index. Beta less than 1 is much widely accepted and lower beta value is better for the fund's performance. The seventh indicator is alpha, that shows the excess return of the fund compared to the benchmark index. Higher is the value, better is the fund. Eighth and ninth indicators are PE and PB ratio. Almost everybody knows what PE and PB ratios are. Lower is the value, cheaper is the fund to purchase. Relatively, lower value fund should always be the best purchase in this case. 10th indicator is turnover ratio. This ratio shows how many times in a year the portfolio is generally churned. This means how many times stocks buying and selling has taken place in the fund. Higher turnover ratio increases the operational cost that badly affect the fund's performance and the portfolio return. Relatively, lower value is always preferable. 11th and the last indicator is fund expense ratio. This ratio directly affects your pocket. Fund expense ratio means percentage of commission that is charged from you for managing your funds. Higher expense ratio means you have to pay extra commission to the fund house. Before selecting any mutual fund, always consider this cost factor. As you can see behind me, on the basis of these parameters, we have compared 24 tax saving ELSS mutual funds where you can enjoy the tax benefit up to rupees 1,50,000 subject to lock-in period of 3 years, and we have found that only 2 of them stands best and close competitors of each other. Those funds are Quant Tax Plan and Paraikh Tax Saver Fund. Their analysis result you can see in this sheet, and among these 2 mutual funds, the owner is Quant Tax Plan that scores 6 out of 11 parameters, and Paraikh Tax Saver Fund scores 5 out of 11 parameters. But still, as the fight between these 2 was very close, both of them can be considered the best ELSS fund to invest in. And like this, with the help of these indicators, you can also choose other mutual funds too, like an expert. Till then, if you find this video useful and educative, then kindly subscribe the channel and press the bell icon for more video updates. And kindly share this video with your friends, colleagues and family members so that they also can be benefited and they can choose the best mutual fund suited for them. Till then, bye bye.